my name's Imogen. I'm an investment fellow with the University of California, which is has an investment office with 120 billion in assets under management. I am moderating our panel after that brief pause. So let's start by having the panelists introducing themselves, say what you do and how you fit into the impact ecosystem.
Great. Thank you. My name is Amit Bori. I'm with the Global Impact Investing Network. It's a privilege to be here with all of you, and congratulations to the GSG on another successful event. So the Global Impact Investing Network, my organization, the GIN for short, is a global network that includes over 280 investors in 41 countries. These range dramatically in size, scale, and type. So we have everything from local fund managers operating in emerging markets to some of the world's largest financial institutions, all who share a common belief that investment can be used to have a positive impact on the world. And increasingly, we're seeing more and more engagement from the mainstream investment community, which I think is one of the topics we'll be talking about here today.
My name is Ian Simmons. I am co-founder and principal of Blue Haven Initiative, along with my wife, Liesl. We are a single-family office, so we invest, we don't take outside funds. We invest just for our family and for future generations of our family. So we are intergenerational fiduciaries. We invest for profit and with purpose, and we look across every asset class to see how we can improve the impact of what we're doing through our investments.
Good morning, everybody. Nice to be here. My name is Nick O'Donoghue. My background in impact investment is I was co-founder of Big Society Capital with Ronald Cohen in the UK. I worked for a time on blended finance with Bill and Melinda Gates Foundation, and currently I'm the Chief Executive Officer of CDC. CDC is the world's oldest development finance institution, 100% owned by the UK government. We have a $5 billion investment portfolio focused almost exclusively on sub-Saharan Africa and South Asia, so India and the neighboring countries.
So I think the question here is, to achieve the change that we need to see and tackle the problems that we need to tackle, we're going to need large amounts of capital, and that means large institutional investors showing up at scale. And so, we know that there are a large number of investors who have signed up to the PRI who have sort of made pledges, but it's not clear that that's necessarily showing up in terms of sort of writing checks to true impact investments. And so how do we turn that around, and how do we do it quickly? So Amit, sort of starting with you, what do you see, are institutional investors impact investors?
I think they can be. So I think that one of the things that's really important about the moment that we're in this market is that a movement that was largely built by people who are not representing mainstream financial institutions. We're now finding ourselves with a whole host of major pension funds, insurance companies, and other major asset owners becoming interested in impact investing. I think the PRI, which was cited earlier, has certainly seeded the field by getting more and more investors to be focused on their environmental, social, and governance factors. But now the opportunity that we have is to take institutional investors that next step to investing in positive impact or directly to fueling solutions to social and environmental problems. But this isn't new. It's already been happening. And I think that's one of the things that's so exciting about this moment that we're in today, is that we already have a number of major institutional investors that have been very active in the impact investing market and are proving the model for others to follow. So firms from all around the world, including some that are represented here today, like Prudential Financial out of the US, AXA Insurance out of France, Zurich Insurance out of Switzerland, as well as a number of Dutch financial institutions, have all been active in impact investing, and most importantly, have been increasing their allocations. So I think the real question for us is, how do we make this more the rule rather than the exception, and change the way that all investors view their assets, which is that it has a purpose that's greater than just earning more money, and rather we can put impact at the heart of all investing decisions.
So what do you think that those investors who have sort of made this commitment need to do to provide the leadership for others to follow?
Well, I think I think we need two things. I think that we need a shift in practices, but we also need a more fundamental shift in thinking. And the shift in practices speaks to a lot of the tools and resources that we're all focused on building. Earlier this year, the GIN came out with a market roadmap that included perspectives from many people in this room about what it would take to build a world where all investors took into account their social and environmental impact. And a couple of things that were key to that roadmap. One is building kind of the tools and resources that investors use. So asset allocation tools, portfolio analysis tools, and other things that help them measure the impact that they're achieving. But the second part, I think, is just as important, if not more so, which is a shift in thinking. So we need to fundamentally shift the way that people view the role of capital. And we also need to shift the way that investors view their responsibility and role in society, which is not just about maximizing returns without any regard for impact, but is rather, solving for impact alongside risk and return. And I think that shift in thinking, the paradigm shift that we need to make is fundamental to shifting the way that other investors become active in impact investing.
So Ian, you're a family office, but you sort of function as an institutional investor and view yourself as sort of having institutional quality processes. Like, do you represent that shift in thinking? And if so, how do you invest and how do you share that with others?
Yes, so we function effectively like an endowment, and so we are an institutional investor from that perspective. In our thinking, we believe that every investment can have positive and negative impact, and so we look to see what the money is actually doing. When we started our family office, we just did a scan of what we were already invested in and discovered some things we thought were just terrific investments in companies that were both performing very well as creating products and services that are of real benefit to the planet and to people. And we discovered some other ones that had some real questionable practices. And then there were some gray areas. But it was very useful for us to understand that every investment we felt was connected with positive and negative impact. So as a family, we established a floor of things we just wouldn't want to be associated with. As my wife likes to put it, we don't like investing in products that, when used properly, kill people. But that does eliminate some, actually. But it's actually important to establish a floor. It took a long time for many institutional investors to decide that there should be a floor on investing. So the Harvard Endowment did decide not to invest in cigarette companies. That was a big step for them. And other endowments have taken similar approaches, that no matter the returns of a company, at some point you just don't want to be a part of it because it has such a negative consequence, and it's a bad example for others. So that's part of our approach. We believe that also it's not just a trade-off. It really, as David Blood was saying earlier, there's a lot of value in really understanding what investments are doing and in thinking long term. And we think there is actually alpha to be had when you are fully understanding the long-term consequences of your own investment decisions. And that's our approach. The way we look at it across every asset class is to find best-in-class performing sub-asset classes and best-in-class performing companies. And then within those, try to find ones that are also creating the most positive impact. So really, it's investing with higher standards. It's having every investment having to go through two diligence processes, a financial diligence process and an impact diligence process, and then selecting from that universe when possible. There are more complications to it I can run through a bit later, but that's the basic gist, yeah.
So can you give an example of where investing in impact has been a provider of alpha?
Well, I mean, actually, David's approach to sustainability, he was a little too modest to say it, but it's a top-performing fund, and one reason for that is they really do take into account ESG in a deep way. So that's an obvious one right there. We'd also have an investment in a private credit fund that whose whole approach is to have a more diversified loan portfolio and to look more deeply at what the underlying borrowers are actually doing with their resources, and they outperform from risk-return profiles. That's CIM.
Okay, so Nick, I promised that I wouldn't ask you wonky questions about modern portfolio theory. So instead, we're going to talk about the Sustainable Development Goals. And it seems like a lot of investors have seen the SDGs, or institutional investors have seen that as a framework which works for them in terms of conceptualizing impact. As somebody who's really on the ground making these investments, do you agree that it's a useful framework for them? And B, you see them really walking the walk in terms of doing these investments?
Thank you, Imogen. I didn't say I wouldn't answer question on modern portfolio theory. I simply said that my modern portfolio theory was a little bit rusty after 30 years. But let me, before I answer the question of the SDGs, just make one very obvious statement, and that is that we have come an enormous distance. So for somebody like me who started in the investment business in the early 1980s, the first 2 decades that I spent in that industry, this subject was never on anybody's agenda. And so the fact that in 2018 we can sit here and we can seriously talk about having a quarter or a third of the $100 trillion of assets that are invested in the world today, having at least some sort of ESG screen, so at least somebody somewhere is asking the question, or beginning to ask the question about what sort of impact does my investment portfolio have. I think that's a very significant step forward, and we shouldn't lose sight of that. But as I think both Ronnie and David and other speakers have pointed out, we still have an enormous distance to travel. The SDGs, launched 3-4 years ago, I think have been an enormous positive for the impact investment industry, because it's given us a framework, and it's given us to some extent a set of metrics that we can benchmark against, and certainly a set of issues and objectives that we can, and a timeline that we can look to. I suppose the challenge I would offer the room on the SDGs, and what I see every day in my job as running a CDC. CDC, as I said, we invest principally in sub-Saharan Africa and India. And the challenge I see, and particularly I want to talk about the African element of it, is that if we get to 2030 and we're looking around the world and society's looking around the world and we still see pictures of we still have 5 million children dying of malaria in Africa, and we still see pictures of children going to bed hungry, and we still hear stories of women not receiving education, and people living in poverty. I think it's going to be very difficult for us as a society, no matter what we've achieved in the United States or the UK or even in India. I think it's going to be very difficult for us to really feel good and really feel like we've come close to achieving the Sustainable Development Goals. And as I said, when we at CDC, when we look at Africa today, and you would think that with all the attention that's going to the goals, with the obvious appetite that exists among the investment community around the world to invest behind those goals, you would think, and with Africa being the poorest continent in the world, you would think that you would be seeing a significant increase in capital flowing to that continent. And in fact, the reverse is true. The amount of capital flowing to Africa over the last 4 or 5 years has declined. It has not risen. It is more difficult for banks to invest because the capital ratios are higher. The amount of private equity going into the continent has halved in the last 4 years. So I think this, for our community, presents a very real challenge. We started today with a video showing 2 case studies of impact investment. One was education in Liberia. One was Narayana Health here in India. 2 very different investments. In fact, CDC is invested in both. We're a shareholder in, significant shareholder in Narayana Health, and we're also invested in 2 companies, Bridge and Rising Academies, that provide education in Liberia. And I can tell you that today it's very easy to find, or much easier to find, investment to go into hospitals in India, because demonstrably, as Dr. Shetty has proved, there is a significant market for that, and it's possible to earn a return in it. It's much more difficult to find investment to go into education in Liberia. We made our investments, as I say, through Bridge and through Rising Academies. Neither of those, particularly the Rising Academies, is a fund that we invested through a fund based in Sierra Leone. It is almost impossible to find, despite the fact that, as you saw from the pictures, that these organizations are doing fantastic work in those countries. It's still very difficult to find investors willing to take the level of risk to go in and address those really difficult issues. So I guess my sort of conclusion is we've made we've made enormous progress. We still have an enormous amount to do. We need to move to a sort of a portfolio allocation methodology that doesn't just look at risk and return, but also looks at risk, return, and impact. Some of that impact will be value accretive in the sense that it will perhaps reduce the risk of our overall portfolio, and so we'll be able to earn, the equivalent return for the same or less risk. But some of it won't, and we exist here on a continuum. And I suppose my ambition and CDC's ambition is to try and find more ways to motivate and mobilize people's capital to go into really the most difficult places.
So why is it that you think that a portfolio allocation model is the solution?
I'm not sure that I would say that a portfolio model is a solution. I mean, I think we have many institutions, or most institutions, currently look at risk and return. I think if we're going to incorporate, really incorporate impact into that, so we move from a sort of a two-dimensional model to a three-dimensional model, we're going to need to feel that the investment portfolio shifts a bit towards those areas and those opportunities that present the greatest impact. So to the extent that we can find easy to define, Ronnie mentioned this earlier on, to the extent that we can get better metrics, to the extent that we can define more easily how we measure impact, hopefully that will have that effect.
Amit, are you seeing people do that in terms of how they think about their investments and their portfolios?
I think so. I think we're at the beginning. But if I could actually touch upon this SDGs briefly, because I do think it's a really important point to bring into the discussion. I think Ewan did a tremendous job in framing the SDGs in a way that created room for the private sector to not only be aware of them, but actually see a role for themselves. And we've seen great uptake in at least conceptually for the SDGs among leading companies and investors. We think it's absolutely important for the GIN, for the impact investing movement, that we try to focus our contribution towards the SDGs. And we actually published a piece soon after the SDGs came out in Institutional Investor called A Capital Call for the World. Trying to make the case that we should think about the SDGs not just as a corporate social responsibility effort, but as something that is a portfolio strategy. Now, where we've seen progress is that a number of investors and companies have chosen to align their work with the SDGs. And it provides an incredibly valuable framework so we can all get on the same page about how we're contributing to a more sustainable world. But where the gap exists is actually the commitment of new capital to bridge the massive financing gap to achieve the SDGs. And I think that's the real call to action for all of us. And I think David Blood did a great job of highlighting this, that the urgency is immense. 2030 may seem like a long way off, but if we are going to do things like bring 1 billion people access to clean and renewable sources of energy, or even something as audacious as eliminating poverty, we have to make a lot more progress fast. And I think to do that, things like changing the rules of the game are critical. And tools like asset allocation resources are very fundamental to how investors do make decisions. So I think we need to reinforce the fact that we have to shift the way that we're doing things. We have to build a new business as usual. And to do so, we will have to build a whole new set of tools and resources that allow capital to flow to the most effective solutions, whether you are a large global investor or a small boutique.
So isn't the challenge, though, that we don't have 5 years to do that? Like, I'm $120 billion, University of California. In order for me to become the sort of catalytic capital, I already need to see that it works and that I'm going to make money. And those examples don't clearly exist. So, is it looking to people like Ian and people like Nick to be that and then building on that? Or how do we accelerate the change?
Well, I think we're now at a point where I do think we have a lot of the data and a lot of the examples. I'd love to have more, but we do have a strong track record of financial performance. I think we also have more and more examples of leading institutional investors who are active in this market and are increasing their commitments with time. I do think one of the things that we need, though, to really shift the way that we think is to be very clear about how institutional investors play in this market and how they don't. Because I think we can be very muddled with presenting a very diverse market to investors who are operating at scale and view things through a very specific lens. So as you know better than I, institutional investors will require the ability to cut a very large check with a very clear sense of returns, a long track record, and they need a lot of co-investment. So if you're talking about some of the things that Nick and his team at CDC do, where they're looking at some of the, taking capital where capital has never gone before, if you will, that is an important role to building a market in the long term. But institutional investors, will only fit in those areas of this market where there's more established track record and scale. So I think figuring out that bridge between the pioneering work of many of the people in this room and where that hands off to larger scale investors to take it to a much more dramatic scale of financing and of impact is one of the critical questions that we have to solve very soon.
I could illustrate that point with our portfolio. So we actually invest for market-beating returns. And that means that we don't invest in first-time fund managers unless there's some extraordinary set of track record behind them from a previous experience. So a lot of the needed funds out there that are being built, we're not going to invest in as a family office from the commercial side, from the market rate side. We do have a philanthropic portfolio. And from that philanthropic portfolio, instead of just making grants, we also will sometimes invest in first-time fund managers. We hope that capital will recycle and when we'll get that back. But the risk-return trade-off is not justified by our asset allocation model. So we think there is a full spectrum of capital that's needed to create positive change here. But it's important to be realistic from the perspective as a capital owner. Another challenge is for us, as we're actually investing as an asset in impact, is understanding where their market's going and where the opportunities are. So not every asset class, there are opportunities we'd like to see. Hedge funds, which is a traditional asset class with many family offices, we actually didn't see very many opportunities in this sector, and we didn't want to get involved in a very long-term lockup as we saw the impact space growing. So we found alternative solutions to construct our asset allocation that would meet our family's financial goals. We've done more than the private credit side, for instance, and we're satisfied with how we're doing that. But we do think there are some opportunities to, as a family, if you're trying to invest for impact across a portfolio, to make some smart choices and end up with a portfolio that would match or beat any other endowment portfolio.
So do you think it's helped that hedge fund performance over the last 5 years has, to use a professional term, sucked? So
that completely helped that decision, yes.
Go
Yeah, and I was going to say on this question I think there is an increasing level of evidence that embedding, as David talked about, and David's generation is testament to this, embedding disciplined, rigorous environmental, social, and governance criteria into your investment process adds to return, it doesn't subtract from it. We've also seen here in India that where CDC is the largest LP in private equity funds, we've invested in 50 separate funds since 2000. Actually, what has generally been a rather disappointing performance by that asset class in India, among the best performing funds are funds like Avishkar and Low Capital, which have very specifically had an impact focus at the beginning. So I think there is plenty of evidence and an increasing amount of emerging evidence that embedding those criteria into your investment process and thinking not just about risk return, but risk return and impact can be accretive to a portfolio.
So, I mean, isn't one of the issues here that sort of generation is the exception and not the norm, right? That there hasn't been, you're seeing it now in the last couple of years, but there hasn't really been a stampede of managers following the generation model despite its apparent success. And you presumably see that when you're looking for investment opportunities.
Well, generation's the exception because they're excellent managers. And there are not many, by definition, you can't be, in the top percentile. Not everyone can be in the top percentile, right? So the point is that, good investors are good investors. And we need to understand that some impact funds will succeed, some will fail. But on average, actually, as the Wharton study shows, impact funds do just as well as other funds when you take into account the quality of management. So this is really about choosing managers well, choosing companies well, just like you would in any investment decision. For us, impact investing isn't like a new way of doing things, really, except just trying to go deeper to understand what the resources are actually doing and taking into account the long-term impact of what a company's actually doing. This builds a little upon like our own family experience. You know, in Liesel's family, her father was most proud of a company that made a medical device that helped save lives. And in my family, we were very proud of the fact we were part of a company that lowered prices for farmers in the 19th century across America. It was the Amazon.com of its day, by producing a catalog to send to farmers in rural areas and cut out the middlemen. You know, these are just companies that are producing real solutions, and this is how families make money. And we just decided we wanted to do more of that across our whole portfolio.
So you mentioned choosing not to invest in tobacco, and that more institutions are sort of making what doesn't sound like a monumental choice, but sort of is considered a huge hurdle for them. And you know, if you talk to sort of CalPERS and CalSTRS, they'll talk about how they hate the fact that they divested from tobacco because they lost money. And so there is this, you know, there is still this sense by even the PERS and STRS of this world that investing for impact means leaving opportunities off the table. So how do you get investors over that hurdle, or do you not?
Well, I think there are two things. There is just a sense of who you are as a person, right? Like, at the end of the day, do you want to kill other people or not? You know, do you want to be part of that? I mean, that's a real thing. Like, the cigarette companies actively market, like, to kids, and more of those kids will die. And so, at a certain, you have to draw a line somewhere as a family, and we can't tell our own kids we want to market to other kids and have them be more likely to die. So, like, as family offices are well positioned to make that moral choice. You know, institutional investors, many of them we believe are well positioned to do that. Many of them grew up in an environment and was me first all the time with only short-term thinking. And we're all paying the price for that in our global economy. You know, we paid for that price in the financial crisis, for that culture in the financial industry. It was like, let's just pawn off bad stuff to other people. So that attitude is not constructive. So we don't want to teach that to our kids. The other part is it does force you to try to find the good opportunities. We think that trying to think about the economy of the future is a very productive way. There's plenty of great business opportunities out there where there's ways to make money and do good at the same time. So why not direct your investment team to find those?
I think, Imogen, if I could hop in here, I think one of the big kind of migrations that we're seeing is, several decades ago, there's a big movement around ethical investment. Getting the bad stuff out of your portfolios, and that has continued to build over time. And then the big shift was to ESG investing, which for many, not all, but many people are focused on that as a way of mitigating risk. How can my environmental exposure, climate exposures, make my portfolio susceptible to greater risk and greater vulnerability in terms of returns? And I think the shift that we're seeing now in the institutional investment landscape is one that, where we're not just looking about avoiding harm, we're not just looking at mitigating risk, but actually shifting to how do we actually positively invest in the solutions to social and environmental problems. And we've seen that being incredibly motivating for many institutional investors. And a big development in the last 2 years, I think in large part due to the SDGs, is that conversation is moving up the org charts. Many big institutional investors have had an ESG unit or a responsible investing unit where a lot of this work was housed. But increasingly, I'm spending time with CEOs and CIOs of pension funds in Europe and Asia and in Australia who are now starting to think about how they can put their capital work to invest in positive solutions. Now, I think that the dollars haven't quite caught up to the interest yet, but I do think it's an incredibly positive sign for the long-term prospects of this movement.
And I would just add, for us, we gave our venture team a mandate to be an impact venture team to find ideas that would both scale as well as have positive impact. And so where we ended up actually was sub-Saharan Africa and renewable energy and fintech. And because right now there's more mobile money adoption in Kenya than almost any other country in the world. So we're actually learning a lot how mobile money works there and how to reduce transaction costs for low-income families. And these kinds of learnings both help the companies we're invested, but they also help us have a global view on where the economy is going, where fintech is going, and help us be smarter investors. So what we found is interesting is that the drive to find impact businesses has led us to be able to get into conversations in Silicon Valley and other places that we wouldn't have been able to be in because we're actually on the leading edge of many markets.
Yeah, I think the other point I'd make on the issue you raised, Imogen, is that I think we do need to demand that pension trustees think broadly about what their responsibilities are. I mean, it is, and we've seen this very effectively done in the Netherlands, for example, which has some of the largest pension funds in the world, where trustees there are looking at it and saying, look, it's not just about how, maximizing the return of this portfolio over the next 20 years. It's also about making sure we're creating a world that our retirees want to retire into. And so the idea that it's therefore acceptable to invest in tobacco, which historically has generated reasonable returns, but as Ian says, it is a product that kills people in the developed world, increasingly in the developing world. I think that is, to some extent, we need to have our trustees making some of these moral judgments and thinking, as I say, more broadly about what it is, what their role really is.
But that's kind of what I was getting at earlier. It seems like the US system in particular has been very against allowing sort of moral judgments to influence investment ideas. So the US version of fiduciary duty says you shouldn't do that. Similarly, sort of the US endowment investment model, to sort of go back to portfolio construction, is very opposed to that. And so how do you push back against that and sort of educate the investment community and open up space for them to say, no, it's okay to make a moral decision as well as a financial decision?
Well, there was a rule change in the United States that we helped bring about, the U.S. NAB that was a part of, which was to clarify that it's okay for pension funds, all other things being equal, to make an affirmative action to decide to invest in an impact or ESG-aligned investment. And that's a critical thing, because that's actually how we do it, basically, is we look at the field and we make an affirmative action, given similar risk-return profiles, to invest in companies and in funds that are having positive impact. Over time, that will really add up, having that affirmative choice. So it actually now, it is possible for fiduciaries to do it. We think it's not just possible, but it's essential for fiduciaries to do it, because fiduciaries are supposed to help their beneficiaries, and if they're involved in business practices that their beneficiaries will pay for, whether it's cigarettes is one, but another one is just the increased consequences of climate chaos that our children and grandchildren will be paying for, that's another one. It's not just a moral decision, it's a scientific decision. So, one of the big debates with US universities is whether or not, how to deal with the carbon crisis. And many are being challenged to divest from coal. But a flip side of that challenge is then invest in renewable energy and invest in renewable energy solutions. And they're finding things even of taking their parts of their endowment and converting it into a fund to improve the energy efficiency in their own campuses, and they're getting a return from that actually helps complement what their endowment's doing, because it's not correlated with the markets in a traditional way. So what's really, again, interesting is the drive for impact's often finding solutions that help a portfolio and help its overall performance. So we think just the questions make a big difference.
I think, Imogen, if I can, on this point of fiduciary duty, I think it's a really important one. And one of the things that we called for on the roadmap is actually, kind of a redefinition of fiduciary duty, so that it does incorporate social and environmental issues. Because ultimately, fiduciary duty is about, representing the interests for a pension fund of your pensioners, right? Make sure you're acting like in their best interests. And I think it's important for us to really explore what those interests are, because of course there is, the money that they have when they retire, but of course, there's also the condition and the state of the world that we will leave for them. And I think one of the things that's so important for us, in not just thinking about this as a market and an industry, but also as a movement, is to make sure that we actually don't just think about the role that wealthy managers of capital play in this movement, but also the role that pensioners and society at large has in reshaping the expectations for how their money is invested. Because if there is a broader-based movement that really changes the expectations that people have for investing, so that the purpose of my retirement fund is not just to maximize returns, but we're actually redefining value and worth, so it includes a much more holistic view. I think that will create the mandate for the professional money managers to invest in a more sustainable way.
I mean, I think that really made the difference on climate change, right? It was sort of being galvanized by stakeholders that forced the institutions, that and sort of the economic argument and sort of the stranded asset risk discussion forced institutions to sort of wake up and start saying, no, we should take this seriously. So I guess the question is how do you take sort of that awakening and push it into the broader impact conversation?
Well, I think the single biggest change in the investment in the United States in the last 20 years or 25 years has been the move from defined benefit plans to defined contribution plans. And what you're describing, the role of trustees, we're talking about a defined benefit plan, which has a significantly diminished share of that overall market. So I completely agree with Ahmed on fiduciary, and let's be clear here that the United States has the narrowest definition. The issue you're raising is a US issue. It doesn't apply in Holland, it doesn't apply in the UK, it doesn't apply in many of the other countries with large pension funds, because they have always taken a somewhat broader view than the Americans have. But increasingly, pension assets in the US are dominated, as they are in the UK, by defined contribution plans. And the difference between a defined contribution plan and defined benefit plan is the pensioners get to decide what they're going to invest in, generally decide what they're going to invest in defined contribution plans. And I think what you're seeing, and one of the things that's driving the increasing availability of impact-oriented options in the US and other countries, is the fact that the people who actually own these pension plans have this desire to see their capital used in a constructive way. So I think you'd expect it's not an accident. It's wonderful that Larry Fink writes letters from BlackRock to talk about the importance of impact investment, but he's a businessman. He's doing it because he recognizes that the people who are buying his funds are increasingly care about having this option. So I think it's important that we encourage choice. It's important that we, as they have, for example, in France, where they've mandated choice. And I think when we offer that choice more broadly, what we will see, particularly in those pension plans where it is the individual who's making who has the opportunity to make the choice, I think you'll see more and more of them embracing, as Ian does, the impact choice.
I think a key part of all of this is to demand more of one's financial advisors as well as one's investment partners. So for us, it's not just saying we want some venture funds, but it's saying we want venture funds that are having higher impact. So you go to Elevar, which is a fund based in Bangalore, and we're with them partly because their dollars are going farther to create a higher impact while also aspiring for venture returns. They actually map the SDGs that their companies are addressing. And for us, that's a sign that they are leaning into companies and solutions that will have a higher impact over the long run. The reason we're investing them is a financial one because of our asset allocation and because of their positioning in our portfolio. And we think, again, the way we find managers like that is to push our investment advisors to go out and look for them. So if there's a takeaway for family offices, it's expect more of your financial advisors. Ask them to work harder to find investments that are also working harder, that are really investments with higher standards.
So we have 1 minute roughly left. My last question is, how long do you think it's going to take for institutions to think in terms of risk, return, and impact? Or is it already here?
Well, I like the view risk, return, impact, but I actually would argue that impact is embedded with one's view of risk and embedded in one's view of return. So for us, we actually incorporate our impact analysis into the risk analysis and into the return profile analysis. So we don't need the third one because it's already part of our investment.
So you've moved beyond that.
Thesis, yeah. So, but if the third one helps people come to understand that the impact's an important driver, then that's good.
I think there isn't a mainstream investment institution in the world today that isn't sort of at the board level that isn't thinking about how we can be in the impact investment market. I mean, that is if we go back even 5 years to the first time that the first conference that we had in London, that was absolutely not the case. Today, every single investment institution is thinking about this. I think the challenge is how do they implement in a way that is constructive and is marketable to their client base.
I think I just add that this is, we are building the data, we're developing the tools, but most importantly, what this will require is real leadership. From those institutional investors who are here, who are already committed and can serve as advocates to their peers, but also to all of us who have a role to play in really shifting kind of the paradigm about what we expect of investing. And I think that's why it's so important to see ourselves as a movement, because we all have an obligation to leadership, and I can take on our role at the GIN in that we are committed in our new strategy to directly working to mobilize capital from institutional investors. So we can make some real headway in the next few years in shifting the landscape of institutions that are committed to impact.
I think that is it. We are out of time. So can everyone join me in thanking my illustrious panel?